The ProAct Know-How.
Hi, this is ProAct. Welcome to this live webinar. There's a few interesting issues that are going on at the moment that we should consider about Brexit. You might have heard a bit of it in the news. We're here to help expats living and working abroad for their family and business cross-border and down the generations, and consider what's going to be changing and what expats can do and anticipate in the future going forward. So as we've been saying for a couple of years, there is a withdrawal treaty that's been agreed. The EU have opened it up, have amended it. I've not read the detail of it. Many people are doing that today. But essentially, this withdrawal treaty that's come forward is the same as the previous one, with a few amendments that allow people to go ahead. But despite what's been said in the media, this isn't just a withdrawal deal. It's an international treaty. So that treaty has been signed off by the EU Summit Council yesterday. It's been signed off by the UK government, the legal authorities. Once that treaty is verified, then it becomes law and it can't be amended. And this is what stopped the treaty being passed in the UK Parliament in the past, for the different vested interests from the Irish issue to customs union. And so I want to look at some of those and how they're going to impact for expats. So if the withdrawal treaty is passed on Saturday by the UK Parliament, and let's assume it goes through the European one anyway, then that treaty can't be varied. The good news for expats is that we would then have a transition period where nothing would change. Brexit would happen and we'd still have through to the end of 2020, 15 months to make any adjustments or changes to our business or circumstance that might be needed. There is still talk about an extension to Brexit, and a new word that's been created this week by the outgoing president of the EU, where he called it prolongation, that in terms of will they give another extension to Brexit date. I think that with the deal that they've done, the EU has conceded some big factors and the UK have conceded some big factors to come up with a deal that works, that allows the UK to be free of the EU European Court of Justice rulings on and insights on its law in the future from day one, but while retaining the concept of a borderless borderless island. So how have they done that? That's the interesting thing. There's a report in the Financial Times saying that the numbers for the UK Parliament to vote are 3214 and 318 against. So it's going to be very, very narrow. But that assumes that there is an extension on offer by the EU. The other factor to consider is that the only people that in the EU that can grant the UK an extension are the summit leaders, the 27 other countries that are meeting yesterday and today. So by the end of today, we may hear a statement or we may not, but that is the summit meeting. It's the first one that Boris Johnson has attended since he became Prime Minister, and there's no more before the Brexit date. The withdrawal treaty is signed by the EU and it's signed off by this summit meeting yesterday. They've got other issues to consider with USA trade deals, and the end of October is not just Brexit Day, it's also the end of a 5-year commission term. On the 1st of November, there's new commissioners coming in, there's a new EU president coming in. Now, what decisions are being made behind closed doors there? Do they want to take Brexit into the next 5-year commission, or have they decided they want a clean break? Because if the UK come back after Saturday, say to the EU, we want an extension, then there's got to be the will within the EU to grant that, and all the leaders have got to come back to meet, to vote unanimously to allow an extension. That means no absences, no abstentions, and no negative votes by 27 member countries to consider allowing the UK an extension. So forgetting all the technicalities, if the law is passed, then there is short-term arrangements that the EU and the UK can make to put into effect the international treaty until everything's smoothed out. So we need to wait and see how that's going to work. But the summit meeting, if that's cleared today, then it's all down to the UK vote tomorrow, and there's still plenty of time for the UK to pass the withdrawal treaty and then work it out afterwards with an arrangement. And how I wanted to address that is looking at expat family and business, that VAT is a key part of that. Everything keeps talking about trade deals, customs and treaties. The trade deal will only start being negotiated once Brexit happens. But if Brexit happens with the withdrawal deal, as it stands now, with the transition period through to the end of next year, UK expats will still be able to relocate under the current terms as if they're EU citizens and start their residence abroad, as will EU expats relocating to the UK. If there's a no-deal Brexit, EU expats can't move to the UK from the 31st of October this year. Expats also would have the nightmare of the S1 arrangements finishing on the 31st of October this year. So residency rights, ability to move cross-border, transition arrangements with healthcare allow for all those time for all those arrangements to be carried on. So when the UK have offered the EU and the individual countries within the EU on a bilateral basis the opportunity to make new healthcare arrangements, pension arrangements, trade arrangements, there's plenty of time for them to do that during the transition period in 2020, the 15 months to 2020. VAT is an EU tax for business, and there's some interesting analogies here which might help explain what's going on to us. First of all, the VAT laws in force in the EU at the moment are actually transitional arrangements, and they've been in force since 1992. So that's how long it could take the EU to make decisions and make agreements with all its members. So the current VAT laws are very much a transition, and they do need to change going in the future. And it's such a key issue because they talk about taxes and customs and tariffs. What's that all about? What's the difference between customs and VAT? Well, VAT is an EU sales tax, and it's charged on sales in the EU, and it effectively generates additional revenue for EU funding and EU projects. And that money, if the UK leaves, that is the money that stops going to the EU, and that money can be directed directly to UK projects rather than being put into the EU funds to go to EU projects to build new pavements in Cyprus or new statues in Hull or whichever is the country, the city of culture in the EU for this year. Educational funding, grants from the EU, all are funded through the VAT levies that go into the system. So VAT is charged within a country on all sales, but when it goes cross-border, VAT is allowed. Now, so we've got the EU as a free trade zone, but they've still got this VAT sales tax. If you're in the UK, selling in the UK, you're charging VAT. If you're in Cyprus, selling in Cyprus, you're charging VAT. So when you go cross-border, you don't have to pay that VAT. So what is that about? Is that really a free trade zone? Well, no, it's not, because they have to account for that tax. Fraud, for those that don't know, I mean, it's where one of the examples is where you don't pay your tax. So any business that's not paying VAT is undertaking a part of a fraud. So the window cleaner who takes cash, and when he should be declaring an issue an invoice for VAT, you know, that is technically a fraud in the eyes of the taxman. So that's an issue, and there's a number of ways that the EU can manage that border within the free trade zone of the EU. So they could have actual physical custom borders between each country, because each country within the EU has a different VAT rate. Now, the EU give us minimum and maximum rates and minimum and maximum allowances before a business has to register. A country like Cyprus or Germany has the bottom rate of just over 15,000 euros of turnover before they register for VAT. A country like the UK is beyond the upper limit, which, you know, any over 49,000 euros turnover, every business needs to register. But there's a minimum rate of VAT as well. So on goods sold, there's a minimum rate of 5%. So you might see that on food and restaurants, or holiday services, or a special interest service within that country. And there are maximum rates as well. But, you know, some countries will charge up to 25%, some 20, some 15. So it varies country by country, but whatever the VAT rate of that country, that is the sales tax of that country. So when a British person exports to the EU, or the EU business exports to the UK, they don't charge VAT on the import into France, for example. The VAT is charged when the goods are sold to the end user in France. Now, how do they monitor that? Is it truly a free trade zone where goods can move between those countries when the VAT is to be charged by each individual country? France wants to charge its VAT for all the sales in its jurisdiction. UK wants to charge its VAT for all the sales in its jurisdiction. Ditto Cyprus, Germany, Spain and Portugal. Well, there is borders between the member states for the taxes in the EU, and that you can have a hard border where you've got customs checks on everything going in and out, or you can have exchange of information. And this is how VAT works. Companies register, they have VAT numbers, they issue invoices, they're registered on exemptions, and this information is exchanged around the EU, so any VAT office can reconcile what a business is doing, and the sales invoice with the VAT, with the exemption, is issued in the UK to the end supplier in France, and he registers that as an exempt sale, and that way the two lots of information are clarified and cleared up and reconciled by the VAT officers, and they can both make sure they get all their money. Or do they? Well, no, they don't. There's proposals to reform and update the VAT, and that will be hastened with Brexit if the UK leaves. But there are checks that go on. So the certification and the audit and the VAT invoices and the VAT returns are all checking that cross-border trade. And in addition to that, you have to think that despite there being free trade and free movement, when you get to Calais, when you get to Dundalk, when you get to the border between France and Germany, there are still custom checks. Now they might only check 2-3%, but they're still checking what's going in and out to make sure that everything is certified and verified and correct and for VAT. And so when the UK proposed in their withdrawal treaty that they could have a frictionless border between North and South Ireland, what they're saying is let's carry on and sharing the data, sharing the information like we do with the VAT scheme at the moment, and that will cover all the trade and cover that. But because we've got this treaty and it's binding on everything, the EU's scared of losing money. They don't quite want to do that. So they've come up with this secondary layer of customs control for Ireland, which is the nub of the issue about whether it's going to fail or it's not. Now, when the UK leaves the EU, technically it's not in the EU VAT system anymore because it doesn't want to have the jurisdiction of the European courts. And so they might still call it VAT. It will be still VAT during the transition period, but once the UK leaves the EU, they might still call it VAT, but it's not VAT in the EU sense. And so the UK would have the right to change their laws and change their rules. And this is a bit of a concern as well, but also that have the budget to direct money directly to UK beneficiaries rather than through the EU. So what are customs? Well, customs are also checked at borders within the EU, even though the EU is a free zone. And customs, what's the difference between customs and VAT? The name. They're still a tax. They're still a tax. And of course, we're talking about customs and trade treaties and trade deals and what have you. It's all getting confused. So the VAT is one issue that the EU and the UK are concerned about. Customs is another issue. Now, customs is free within the EU. So the EU is a customs-free zone, not a free trade zone in respect of VAT on sales within the EU. So if goods are coming in from the USA or from China into the UK, at that point of entry, there is a customs check and the appropriate VAT, and any additional tariff is applied to that. So the EU have got the opportunity for the USA to apply $7.5 billion of tariffs from today, October the 18th, onto the EU, because they say the EU have been doing state subsidies to their airline industry, a long-going World Trade Organization dispute between the USA and the EU. But the World Trade Organization is an international treaty to which governments around the world are signed up and the EU are signed up to, so they have to obey those rules. And there's a standard set of tariffs that apply in the event of there being no other trade deal between those countries. So Japan, China, USA trade between each other without tariffs, and just use the word without agreements, so just use the world trade rules. And Trump is in the process of trying to get bilateral agreements to equalise the charges that are going in. His beef with China and the EU is that they're charging tariffs for goods, American goods, to go into China or the EU, but whereas America, as a free trade country, literally applies no tariffs traditionally to goods for people to go and sell in America. And that's what Trump is changing to try and redress his trade balance. So those customs tariffs could start applying to UK assets as they go from the UK into the EU. So that's a separate issue, and that's where people say 10% could be added. That is their opportunity. So how can business get around this? Well, one way is that if a UK business has got a subsidiary, that a branch that operates in the EU, then it can operate within the EU to do that. But it depends upon where the trade is. If it's the occasional bit of business, the worst case you're going to get is a small tariff on that one-off piece of business. If you're doing a substantial operation in the EU, then you need to consider a subsidiary operation or even a transfer of your business from the UK to the EU. Countries like Cyprus offer a haven I wish I hadn't used that word, a jurisdiction in which they can hold their assets for business or property to protect against excessive taxes in other jurisdictions. So Germany, Denmark, France can charge higher taxes. Jurisdictions like Malta, Cyprus, Ireland and Bulgaria, Estonia will charge lower taxes. So what is the best to suit your business? So expats need to consider this how best to operate their business going forward. Now that we have the certainty of withdrawal treaty, it's about making those arrangements for the long-term development of that. As far as residency goes for expats, we've got that certainty now. Again, we've seen over the last few months of the Boris Johnson UK government a trickle of revised laws, preparation for no deals, anticipating temporary arrangements during the transition period in anticipation of a deal. So if that transition period comes ahead, then we've got that period of stability. So permanent residency can be sought, citizenship can be sought to naturalise so that an expat living and working abroad can continue to live and work in that country indefinitely. The UK have offered to carry on with their S1 scheme. Now they'll no longer be part of the EU scheme, but they've offered to continue with the to pay either on an EU-wide basis or on a bilateral basis with each country within the EU, as well as to extend it to other countries around the world. So that will be a big, for the future, that UK expats will be able to have reciprocal healthcare arrangements around the world with a number of different countries where bilateral agreements can be made between the UK and that country. Again, you have to look forward to what your family needs to secure your healthcare. An S1 is issued to somebody of state retirement age, somebody with a medical exemption, students or temporary short-term workers. Contact us at Project Partnership if you want to discuss more upon that. And if you want to look at how to make your EU or UK residency permanent, getting your settled status established, or perhaps applying for dual passport, projectpartnership.com has got the latest information on that, and as well how to adjust your business. So if you're operating from a UK business, you could consider registering it in an EU country, and in that way arranging to carry on trading through your existing business, but under the rules of an EU company registrar that allows you to keep your business with full EU rights. Whether you're an EU citizen, a family or a business, there's still a way forward. There's a big wide world full of expats from America, China, Canada and the UK outside the EU, and it'll just be the arrangements are slightly different. The customs tariffs, the taxes that a jurisdiction charges on entry of goods from outside its jurisdiction will change. So, for example, if you're in the UK and you buy something online from China, it might have a tariff applied to it. That tariff might disappear when the UK leaves the EU, because they make a new bilateral agreement with China. But similarly, there might be no customs tariff that's applied to something you buy from Amazon in Germany, and technically that could apply after Brexit. And those things will all become clear during the transition period, the arrangement of a new free trade deal on a bilateral basis between the UK and EU and its member states. There's still a long way to go for everybody, and it depends what certainty comes out today. But if the withdrawal treaty is not accepted by the British Parliament either in the next 48 hours or by the end of the month, then unless the EU summit leaders unilaterally decide to grant an extension with a majority vote, not just a majority vote, no abstentions, no absences, unanimous vote to get an extension before the 31st, there will be a no-deal Brexit. That's not good for expats. The withdrawal treaty is good for expats, EU citizens living in the UK and UK citizens living in the EU. And contact us and follow our blogs in the next couple of weeks to get an insight perspective for how expats living and working abroad in the EU can manage and protect their family and business cross-border down the generations. Thanks for listening, and we'll see you next time.
The ProAct Know-How, brought to you by ProAct.